Hi, welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Gary Antonacci. Gary has over 35 years of experience as an investment professional focusing on underexploited investment opportunities. His research introduced the investment world to dual momentum, which combines relative strength price momentum with trend-following absolute momentum. Gary is the author of the award-winning book, Dual Momentum Investing, an innovative approach to higher returns with lower risk. Gary's a foremost authority on momentum investing. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Gary Antonacci, author of Dual Momentum Investing. Hey, Gary, where are we chatting with you today?
I'm in Northern California for a while right now.
Great. That's I think we're kind of neighbors, so this will be fun.
Yes, I always enjoy coming down here.
So, Gary, our audience is largely value investor based. Just with the guests that we've had so far, what the idea then of momentum investing is an anthem to many of them, I think. What would be your suggestion that they could learn from the idea of momentum investing?
Well, I hope it's not so much an anthem to them that they don't have an open mind to possibilities here, because value and momentum are negatively correlated, which gives you some opportunity to use the two together and to benefit from that. So there are several ways that you might do this. One is to combine them together using a dual screening for momentum and value. And there's some mutual funds and ETFs out there that do that currently. The other is to hold separate portfolios of each so that you could have portfolios or funds that are value oriented and others that are momentum based. And those two would complement each other nicely. The third way is to use a form of momentum which I call absolute momentum. In the literature, it's sometimes called time series momentum, which is a trend following approach. And what it does is keeps you out of bear markets by stepping aside when an asset hasn't shown strength in the past with respect to its own past performance. So you could have an absolute momentum overlay on top of whatever value fund that you might have, and that would allow you to avoid some of the bear market exposure because value can be subject to severe bear market exposure at times.
Right. So, question number 2, one of the things that I found interesting was that some of the exact same behavioral, finance, and psychology arguments that might explain why value investing works also can be used to explain why a momentum approach can work. Can you give us a little bit more detail about that?
Well, value, I think, is explained a little more based on rational risk explanations historically. In other words, you get compensated for value because you're dealing with riskier assets. Stocks, for instance, that might have a higher probability of going out of business. There are some behavioral factors, though, that come into play. Neglect is certainly one of them because in value investing, you're focusing on overlooked or neglected securities. The same applies in momentum investing. You have some initial underreaction to new information that comes into the marketplace. So that's an example of neglect. There's also herding that takes place under both. Value investors sometimes are not as powerful a force because they don't want to go against the crowd and buy stocks that nobody else likes. Well, the herding effect takes place in momentum as well, but that occurs a bit differently. It occurs when stocks or whatever assets are catching up, and then everyone joins in the bandwagon effect and causes momentum-based assets to extend themselves further than they might otherwise.
Right. I think in my mind it was kind of taking advantage of fear in one instance with value, and then a little bit of taking advantage of greed with the momentum, everyone trying to pile in.
Yes, that's true. And there is some fear with momentum initially too. There's a disposition effect and other things that enter in to momentum type investing that causes fear and greed to play a big part there as well.
So, question number 3. You created a model that you called a GEM model. What is it? Can you just explain what it is? And then why do you think that it backtests so well?
Well, the GEM means global equities momentum. And it's based on the dual momentum concept that's explained in my book.
Mm-hmm.
And in the book, I actually show people how they can implement the GEM model themselves. It's very easy and simple. And the core concept behind it is relative strength momentum, in which you compare assets to one another and you go with whichever is the strongest. And that's been proven academically going back several hundreds of years on many different assets that past winners tend to continue being winners into the future. The ancillary concept that I've employed with it is what I call absolute momentum. And instead of looking at assets compared to their peers, you look at an asset's performance based on its own past performance. And you say, if the trend has been up, for example, say the past year, a stock has been going up, then absolute momentum says that it's likely to continue going up. If the trend has been down over the past year, then absolute momentum says to avoid that asset because the trend is liable to continue going down. So absolute momentum can reduce bear market exposure. And during those times when absolute momentum says that the trend is down, we can step aside from stocks and go into the safety of short-term bonds. So we have a marriage of both types of momentum, relative and absolute. That's what gives the power to dual momentum or to the GEM model that I have. Absolute momentum has been back-tested all the way back 800 years now. So both of these have been shown in all kinds of academic research to hold up across many different asset classes and across a wide range of different markets, and going back in time and going forward in time from when they were first recognized. The other element that I think makes GEM successful and that allows it to backtest well is the portfolio that I focus on. Research has shown that the highest risk premium comes from stocks, particularly U.S. stocks. And that's the core asset of the GEM model. It's U.S. stocks. When foreign stocks are stronger than U.S. stocks, then we'll temporarily go with foreign stocks. And when neither is showing strength based on absolute momentum, we'll stand aside and wait until the trend is positive again.
And that means treasuries?
You can use treasuries. I prefer to go into short to intermediate term aggregate bonds.
Okay.
They have about a 5-year duration and don't bear a lot of interest rate risk. They do give a better return than treasury T-bills would. Treasury bonds are more volatile and you're bearing more risk then. So I tend to stay away from those myself.
Yeah. So question number 4. Can adding momentum, let's say as an investor, be as simple as if I was looking at individual stock A and individual stock B, going with the one, and they were pretty much on par with each other, picking the one that had the strongest relative strength? Or are you in more favor of a basket of relative strength companies that are, more of a diversified approach?
Well, momentum will work on anything. You can use individual assets, you can use asset classes, you can use baskets. The problem with individual stocks, or even a small group of stocks, is that you have a lot of risk that isn't being diversified away. So your volatility and your tracking error is considerable. So I prefer to work with larger sets. The problem with dealing with individual stocks is that momentum, relative strength momentum, tends to select smaller, higher beta stocks having large bid-ask spreads. Also, the turnover is very high. So your transaction costs can be considerable. And there's some research that shows once you factor in those transaction costs, you're not left with very much in the way of momentum profits. So I prefer to use asset classes. As I mentioned before, in the GEM model, we use US stocks versus non-US stocks. And there's very few switches that take place on that basis, so your transaction costs remain quite low.
That makes sense. This question number 5, given what we know about human nature, behavior, and how that affects the marketplace, how much of the magic of momentum-based investing do you think is just having a system and sticking to it, and trying to take kind of the emotional elements out of the decision-making process?
That's very important. There's no doubt about it. And that applies to everything, whether it's a momentum-based system or some other. If you look at the Dalbar studies, which are done every year, they show that individuals making investment timing decisions don't do a very good job. They're usually subject to fear or greed. So it's definitely worthwhile to have a disciplined, quantitative-based approach that you can stick to. The advantage of dual momentum, as I've developed it, is that by looking at the past results, even though you can't say that they predict the future, they may give you more confidence to stay with your model, because you can see that the bear market exposure with dual momentum is not as great as it has been without it.
Right, so it's easier to stomach the...
whatever volatility there is. Of course, there still is some short-term volatility because dual momentum is a longer-term based approach. The magic really, though, comes from the proven superior risk-adjusted returns that are inherent in relative strength and absolute momentum, along with the reduced bear market drawdowns that come as well from a dual momentum approach.
Right. So question number 6, this is our bonus question that we always ask every author, and it's about a book recommendation. I'm curious to hear what you have for us today.
Well, besides my own book,
sure.
I would recommend, I think if I had to pick one book, and in my own book, I give a recommended reading list that's very heavy on behavioral finance. But if I had to pick one book, it would be Stocks for the Long Run by Jeremy Siegel. And at first, I didn't have that high an opinion of the book years ago when it first came out. But I appreciate it much more now because the key point of that book is that the way you make the highest return in the long run is by investing in equities, particularly US equities. Nothing else comes even close. So sometimes you may want to go into bonds or you may want to go into other diversifying type assets, but you're going to have a drag on your performance. So what we do is we'll use stocks and bonds, but we'll use them at the more appropriate times. We'll be in stocks when the trend in stocks is up, and we'll move over to bonds when it looks like the trend in stocks is down, which usually happens to be a good time to be in bonds. So I think Dr. Siegel makes that point very strongly, that stocks for the long run, that's where you want to be. Otherwise, you end up diluting your performance, diluting your returns, and ending up with mediocrity in many cases.
Well, yeah, I think that book has kind of always seemed like black licorice a little bit to me. It's like people either kind of love it or they hate it.
Right.
So, Gary, we really appreciate you coming on the show today. And it's been interesting to get a different opinion about seeing the world. I think everyone likes to talk about challenging their beliefs, their most closely held beliefs, but not everyone does it. So I'm hoping that this will be an opportunity for everyone to, just take a step back.
I hope so too. And if you want to learn more about this, you can go to my website or my blog, and especially my book, Dual Momentum Investing, Strategy for Higher Returns with Lower Risk.
Great. Gary, thanks for coming on the show.
My pleasure. Thanks for having me.